Thanks, Chris. So our next speaker is Ben Olken, who I think I see right there. So Ben, just go ahead and share your screen. I understand you're fresh from teaching, so thanks for joining us.
Yes, I just finished teaching like 5 minutes ago, but I think I should be.
Okay, perfect. And the ground rules are you have 50 minutes to present. There'll be a 10-minute.
5-0.
Yeah,
Okay.
50. And there'll be a 10-minute Q&A at the end. And during the 50 minutes, if you just plan to sort of take a break, like for a few minutes in the middle, where there can be questions that are answered then. I'm not sure if Rima's joining us in the...
I think she had something right until 12, so I think she was planning on logging in right at 12, so you should look for her.
Okay, perfect. So Rima may be joining us soon to answer questions in the chat, but otherwise, over to you, Ben. The floor is yours.
Terrific, great, yes, exactly. So thanks very much. So this is joint work with Khatib Basri Mayara Felix, who's a graduate student at MIT, and Rima Hanna, who will be hopefully joining us shortly. And if someone, oh, there's Rima, terrific. Thank you very much. And the title is Tax Administration versus Tax Rates, Evidence from Corporate Taxation in Indonesia. And so by way of introduction, what this paper is about, we sort of start from the principle or the point that there's low tax revenue is a central challenge in many developing economies. I think that many of you are probably familiar with the idea developing countries collect, say, 10 to 20% of GDP in tax revenues compared to, say, 40% in advanced countries. And there's been sort of a lot of discussion about, well, why is that? And in particular, do countries have the ability to kind of raise more revenue if they wanted to? Or are they limited, by their administrative capacity or by other kind of fundamental aspects of their society? Okay, by, lack of use of the financial system or whatnot. And there have been, I think, a bunch of papers in recent years, which I've listed a few examples. There's an excellent review paper by Joel Semrod that have shown that sort of different pieces of tax administration can potentially be an important part of this puzzle. But I think sort of stepping back to this broader question, I think there's still a lot of uncertainty as sort of like how would kind of a really large scale tax administration reform, how effective would this be? And if you're thinking kind of on the margin for a country that wants to raise more revenue, how should you be thinking about this question of kind of raising more revenue through improving administration versus through sort of changing your de jure tax code and raising rates? And how do you compare those things? And so that's kind of what we want to investigate in this paper. And we want to do that by investigating a large-scale tax administration change in Indonesia. And we're going to compare that to a change in the de jure tax schedule as well. Okay, and so we want to compare kind of on the margin these two different approaches to raising revenue in the same context. Okay, and so we're going to do that by studying two major changes in corporate tax policy in Indonesia. We're going to study them using administrative corporate tax, anonymized corporate tax data. And we're going to study two changes. One is going to be a change in taxpayer administration reform for corporate taxpayers that took place in 2007. And here's what that change was. So as many of you may know, corporate taxes tend to be very skewed. So a few taxpayers pay the most tax. So given that, most countries have around the world have actually or realized that and sort of set up special kind of taxpayer units for their couple hundred largest taxpayers nationwide, which have much more kind of intensive tax administration. And Alumnia and Lopez Rodriguez have studied this, for example, in the context of Spain. So we want to say, well, what's the return to this idea of really intensive tax administration for kind of larger taxpayers in a developing country setting? And we're going to study this by looking at Indonesia's reform, which took this idea to the regional level and created what they're going to call medium taxpayer offices, or MTOs. And for each of Indonesia's 19 tax regions, which covers the whole country, they took this same idea and implemented it there. So they took, for each region, the largest, 300-400 corporate taxpayers in each region, and they moved them to a special tax office. This tax office, as I'll describe in more detail, had exactly the same structure, the same de jure tax environment, and the same organizational structure of like auditors and account representatives and all those people were the same, except it just had more staff, like 3 to 4 times as many account representatives and auditors per taxpayer, and no individual taxpayers. So 3 to 4 times as many people per corporate taxpayer and no individual taxpayers. So it could do much more intensive tax administration. So we're going to study the impact of these firms of being moved over to the MTO using a match differences and differences design. Okay, and I'll explain more about that later. And we're going to find, by the way, really big effects. And we're going to suggest one mechanism why this thing may have been effective is we think it particularly effective is not only was it enhanced administration, but it reduced kind of the degree to which administration was size dependent. And I'll be clear on what I mean by that in a sec. The second reform we're going to study is reform to tax rates. Okay, so we're going to compare this to a change in tax rates. This is going to be for corporate income tax. So pre-2008, Indonesia had a progressive corporate income tax with a marginal rate that was based on your taxable income, i.e. your profits, with a top rate of 30%. It switches starting in 2009 to a system where there's a flat CIT as a function of your taxable income, but they give you discounts based on your gross income, based on your revenue. So you can think of it as a switch from having different marginal tax rates that were a function of taxable income to different marginal tax rates that are a function of revenue. So you can imagine then you can do a 2x2 based on your pre-period kind of revenue and your pre-period taxable income. Some firms are going to get a tax increase, some are going to get a tax decrease, and we're going to use that differential tax change to estimate the elasticity of taxable income. We're going to instrument for your tax change by taking your pre-period characteristics on these two dimensions and then running them through the schedule change. And that'll give us sort of an ETI. And once we have that, we're going to be able to benchmark kind of improved tax administration to like a counterfactual tax increase. Like how much would you have had to raise this rate to get the same amount of tax revenue, and you need the ETI to figure that out. And we'll use that to sort of, we won't be able to give you an exact welfare answer, but we'll be able to use this theory. We're going to adapt this theory from Keen and Slemrod to say, well, to at least do some bounding exercises on what you have to say for this to be to tell us about welfare. So what do we find? Just preview results. So we find really big effects of the increased tax administration reform. So affected firms' tax payments rose by 128% on average over the 6 years after being moved to the medium tax office. So it's really big. The government costs of this were minuscule, less than 1% of the additional revenue collection. So kind of the net return to the government is almost the same as the gross return to the government. That's important because from a wealth perspective, what you care about is the net fiscal externality on the government. We find very similar effects for all three taxes these firms remit, which is value-added tax, corporate income tax, and withholding taxes on behalf of their employees. One thing that's going to be, I think, kind of interesting is we see big increases in reported gross incomes, as well as increases in declared formal employment and the wage bill, not just taxable income or tax payments. And another thing which is kind of interesting is we find that if we look at the time series patterns of this, or the time patterns of this, we find the effects actually grow over time. You might have imagined they get put into this enforcement regime, they pay a lot more higher taxes, but then they're facing like a higher effective marginal tax rate, and that's going to like slow firm growth, or maybe they're going to learn how to evade or something. And we see the opposite of that. Okay, we see on impact effects that then grow over time. And we'll talk about why that might be. But one thing I just also want to mention is these top line results. The higher sort of the fact that we find these results on gross income, et cetera, it's all very consistent with sort of more income or more business being brought kind of onto the books or onto the tax rolls. I think that's sort of an important way of thinking about it, which I think is relevant for the way we think about some of these corporate tax policies. In terms of, and we'll mention one kind of mechanism that we think may be relevant for why they were able to raise tax revenue without substantially distorting or firm growth. And that, of course, that we're only measuring things in reported tax data. And that's this idea of reduction in size-dependent enforcement. And we'll actually show you some suggestive evidence that, in fact, in the old regime, in the regular tax offices, kind of given limited resources, governments are going after the big firms. That's fine. That could create some distortion effects. In the medium tax offices, they become much less, they increase the level of enforcement, but they become much less sensitive to firm size. And so we think that could be relevant as well. On tax rates, we estimate an ETI of 0.6, which is a little bit higher. There's actually not that many estimates of the ETI for corporate income tax. There's an estimate by Gruber and Rao, which gets 0.2. There's an estimate from Germany, gets 0.6. There's one estimate that we are aware of in a developing country setting, which is this Bacchus et al. Bacchus paper in Costa Rica, that gets an estimate of 3, but that's for really, really small firms. So, these firms look, not sort of super duper elastic. And that suggests that actually Indonesia could, if it wanted to, raise corporate income taxes. It's like well below the LAFA rate, for example. And finally, we can do this comparison that I talked about. And the comparison is if you focus on just corporate income tax, the amount of tax revenue you get for CIT would be equivalent to raising marginal rates on all the firms, not just those affected firms, but all the firms by 8 percentage points, which is pretty big. You couldn't actually get the VAT and all those other taxes just by doing corporate income tax alone. And we'll make some arguments to suggest that the sort of the administrative improvements are likely welfare improving unless kind of the private enforcement costs are really high. So that's kind of an overview. Let me outline a talk. I'll talk you a little about the setting. I'm gonna talk very quickly about the model. I don't want to spend too much time on the model. The main point is just to kind of motivate and sort of set up the sort of welfare analysis and empirical work. And then I want to make sure we have enough time to talk about sort of the key sets of empirical results on sort of, you know, on these two different dimensions. Okay. So I guess I'll go till halfway through before we sort of break for questions. Is that right, Imran?
Yeah, that's right.
Okay.
About halfway.
So, yeah. So what are what do you need to know about the institutions to understand this paper? As I mentioned, there's 3 types of taxes: corporate income tax, VAT, and withholding taxes. They're remitted monthly. Annual CIT filings are due by April of the following year. That's going to be relevant for our timing because, as you'll see in a second, and it's administered centrally through all the taxes are relevant through sort of the Director General of Taxation. So it's a nationalized system with uniform law for the whole country. I think, as I mentioned, basically there are these MTOs were created. They have substantially higher staffing ratios, like 3 to 4 times as many account representatives per corporate firm, 4 to 5 times as many auditors per corporate taxpayer, and no individual taxpayers. As far as we can tell, like staff quality and experience is broadly similar. We have some measures of this from kind of the administrative HR data. They're maybe like, I don't know, on average, like 0.4 years more experience. So like 7.6 instead of 7.2 years of experience, and they have sort of similar subjective quality scores based on what we can observe on their performance reviews. So they don't look, the staff don't look massively different in quality, there's just way more of them. The other thing that's important to notice is the assignment. The assignment was, roughly speaking, as far as we can tell, on the basis of pre-period gross income and taxable income. The exact formula that was used may have been different for each of the regions, and the exact formula, unfortunately, was done in Excel, and the Excel sheets have been lost to sort of the recycle bin of time. So we cannot, unfortunately, reproduce this exactly, nor can we do an RD. It's certainly the case that if you look, the probability of MTO assignment is strongly increasing in both gross income, pre-period gross income, and pre-period taxable income, but it's not discontinuous as far as we can see. And that's going to motivate our sort of matching-based design. The other thing is there are 19 tax regions. I'm going to focus on 13 of them today, which are the 13 where they created them in 2007. And the reason is there was also a reorganization of the primary tax offices as well that took place about the same time, around 2007, 2008. And at that time, the primary tax offices were given the exact same kind of org chart as the medium tax offices. So the organizational structure is the same in both. So there's a reform of both in 2007 of both switch the org chart and create the MTOs with a much more intensive tax administration. So by focusing on these, we're going to kind of hold constant this org chart effect and sweep it out kind of with the time fixed effects. So I'm just going to focus on this wave. If we include the MTOs that were created in previous years, we get very similar results. So it's not really consequential, but it's just how we're going to analyze it. We think this is cleaner and it's easier to see. Okay. What is the tax? That's thing number one is the MTOs. Thing number two is the tax change. What's the tax change? Well, I think it's easiest to see here. So in the pre-period, corporate income tax has 3 brackets as a function of your taxable income: 10%, 15%, and 30%. In the post-period, they change it to have a rate that is, they lower the top rate to 28% in the first year and then to 25% in the second year, and then 25% from there on. it's a function of, but then they give you a discount in your marginal tax rate. The marginal tax rate is, of course, always applied to taxable income. So the tax base does not change. It's always taxable income with the same definitions. But the rate, tau, that we multiply by your tax base is no longer a function of taxable income. It's a function of your gross income. So they basically give discounts to small firms as a function of what fraction of your income is below 50 billion rupiah, $5 billion. And so the formula looks like the formula looks like this. Okay, so if all of your income is below, you pay half the marginal rate, and then in this intermediate range, your marginal rate is a function of what fraction of your income is below 50 billion. So the marginal rates look like this, and then the whole schedule gets multiplied by this, multiplied by its discounts. So the whole thing gets lowered in the second year. So we're going to use the shift from this to this for identification. And then we're also going to use the fact that we also get this second shift where the whole thing shifts down, but differently for different firms as an additional diff on the tax rate. So actually we're going to have we're going to be able to have two tax changes that we're going to use to study this. Okay, and our data is we have administrative kind of corporate tax data. Anonymized. The only thing we don't have the couple hundred largest firms in the country. They couldn't sort of anonymize, so those are excluded from our data. The other thing is because the data is totally anonymized, we can't match this data to anything else. That's just kind of is what it is. We also have some other administrative data on a few of the enforcement activities, like formal audits and a few other things, which I'll talk about as well. Okay, so the other thing I want to do is talk briefly about a simple model. I don't want to spend a huge amount of time on this, but I just want to sort of set this up quickly. The key point of this model is actually, the model is going to feature the idea that businesses can hide certain business lines or customer relationships or whatever from the government by paying an evasion cost. And we'll explore how changes in rates and enforcement change this decision. The key point actually is we're going to sort of just come up with sort of this benchmark kind of corporate income tax evasion model. And then we're going to sort of use this standard kind of welfare analysis, which is standard in other PF models, to help us think about welfare. And in particular, Keene and Slemrod have this really nice framework where they extend, so this Feldstein and then Feldstein and Chetty have these arguments about why kind of the thing you want to analyze a tax change is the net impact on government revenue, if evasion costs are real costs. And Keene and Slemrod kind of adapt this framework to allow you to compare changes in tax administration as well. Okay, and so in some sense, we're going to build this simple model of tax evasion, but then the key point is going to be to sort of feed it in and show that kind of these Keene and Slemrod results, which were designed for sort of like a labor income context, to show they kind of go through in a corporate income context as well. So the model is going to look like this. We're gonna have business lines or customer relationships or whatever, indexed from 0 to L. Pre-tax profits on a line are going to look like revenue for the line minus the cost of producing on that line. Okay, so obviously you set the marginal cost equal to 1. In this, we're normalized prices to 1. We're going to assume we have some amount of distortionary taxes here. So this is not going to be a pure profit tax. There's going to be some distortions from taxation. We're going to use this best at all notation and just capture this with this parameter mu, which captures the degree of which what fraction of costs are deductible. So mu is going to be less than 1, and that's going to be why taxes are distortionary. And I refer you to their paper as sort of why that might be optimal kind of in equilibrium. And so, a firm on a given tax line, it maximizes its after-tax profits. It deducts all, so it's after tax and revenue, and then after minus the cost, which just have this mu term, which capture what fraction of them are deductible from taxes. So if mu is equal to 1, it's a pure profit tax, and taxes don't affect the production decisions. If mu is less than 1, then taxes are distortionary. You get an effective tax rate, which looks like this. We then also think about this idea of evasion, okay? And so in our model, you can evade on a line. Lines are going to be ordered by H in their difficulty of evasion. So H0 is 0, and they're going to be this evasion costs are going to be increasing. And this idea B of YL is going to be capture the idea that larger lines are harder to evade. If you're doing more stuff, it's easier for the government to go find it, and you have to do more to kind of hide that activity. Okay, and that's going to allow for interactions between kind of your real decisions and your evasion costs. Alpha is going to be the key parameter we're going to study. That's kind of an increase in enforcement. So we're going to model an increase in enforcement, just making evasion more difficult. Okay, so now on a line with evasion, the firm doesn't pay any taxes on either its revenue, right? So it's just Y minus L, no taus over here, but instead it has to pay the evasion cost. And its real production will be, instead of having 1 minus that effective tax rate, it's 1 minus kind of the marginal evasion cost of being a little bit larger, which is coming through this, where B prime captures kind of the degree to which being larger affects your evasion decisions. Okay, and then basically firms, there's a cutoff value of kind of a marginal line where the firms are going to evade the ones below that and pay taxes on the one above that, and that's just going to be, we're just going to compare the after-tax profits from the evaded from a line where I'm producing and choosing to pay taxes, and evading and not paying taxes. And I think that the key point from this is that, you know, it's possible in this model that an increase in the evasion cost alpha can potentially actually lead to more real output, right? So if I increase my evasion, the marginal line is gonna shift down. I'm gonna like evade fewer lines, but it's not obvious, but I'm gonna switch from I'm no longer paying my evasion costs, but I am gonna pay the distortionary tax. And the effects on real output just depend on kind of on the margin, which of those were more distortionary. And so I've drawn an example here where kind of real output actually increases, but it's ambiguous and can go either way. And that's just sort of to make the point that sort of it's not, that these changes in evasion costs could have real decisions, and that's going to sort of depend on sort of which of these are more distortionary. There's also a potential complementarity between alpha and tau in this model. What I want to what's more important actually than the particular micro foundations of that model, what's more important is the welfare analysis. Okay, so let's just define, so just to make our notation a little bit easier, I'm going to define as by gamma kind of the evasion costs. That's on all the evaded lines from 0 to L star, that's kind of the marginal evaded line of all those evasion costs. So welfare in this context is the firm's post-tax profits on its taxed lines, the firm's post-tax profits from its evaded lines, including the evasion costs, because these are real costs, plus V, which is the social value of public funds, times the amount of revenue that the firm gets. Oh, sorry, I've also defined Z as taxable income. So the amount of revenue the government gets, tau Z, that's multiplied by 1, right? By V, which implies there's some additional value of public funds, minus A of alpha, which is the government's administration costs of collecting the tax revenue. Okay, and so the key welfare question that we want to answer is, how do we think about the change in social welfare with respect to either a change tau in the marginal tax rates or a change alpha in the government administration? Okay, and this is where I'm sort of adapting this Keenan-Sumrad framework. Okay, and the approach is you take derivatives of W with respect to alpha with respect to tau, and you apply an envelope theorem argument. So let's do tax administration first. So what is the change in social welfare with respect to a change in alpha? Well, this is all kind of the firm's profit function. So I have to care about kind of what is the direct effect on the firm. The direct effect on the firm it's d gamma of alpha, d alpha, okay? And then I care about the effects on the government budget constraint multiplied by V. So it's tau, so its effect on total government revenue, tau dz d alpha, that's just sort of the total amount of revenue the government gets, minus the change in administration costs, okay? So we're gonna estimate this thing. How much more does the government get in revenue? We're going to calculate from sort of accounting data how much the MTO cost the government to administer. So we're going to calculate this. The change in private compliance costs is going to be unobserved, and so we're going to have to make some bounding arguments. We're going to have to say, does it look like this thing went up or down? And if so, how big would d gamma d alpha have to be for this thing not to be welfare improving? The second is, and I'm going to go one more minute, Imran, and then I'll take questions. The second is we're going to do the same thing for a change in tax rates. For a change in tax rates, same idea. What's the derivative of social welfare with respect to tau? Well, the direct effect of this thing with respect is just Z, right? Government revenue, right? And then we have the effect of the government budget constraint, right? Which is which is how much does government? Which it's just the derivative of government revenue with respect to tau, and all of these things here. There's no additional parameter. No additional parameter that we need to know. It's all just kind of a function of Z and the change in Z. Okay, so it's all just basically a function. The only thing we really need to estimate here to calculate this thing is the elasticity of taxable income with respect to the tax rate. Okay, so why is that helpful? That's all we need to estimate there. And then once we get this, we can actually calculate, for example, how much would the government have to, how much would we have to change taxes to hold government welfare revenue constant. That's sort of, again, just a function of these various parameters. And similarly for welfare, we basically can say, well, which of these things is this thing kind of welfare improving or not? That's just sort of saying, well, let's imagine we did a welfare neutral change where we increase tax administration but reduce tax rates by the amount to make this thing welfare revenue neutral, or vice versa. We just add up kind of the welfares on those two things. And without going into the algebra, the key point is that all of these things are a function of the three things we're going to estimate in the data and this one kind of unknown term, which is the change in private compliance costs. So everything we need to know is what is the change in government revenue with respect to tax administration? What is the change in the administration costs? What is the elasticity of taxable income? And then there's this fourth parameter, which is sort of how much did the change in private compliance costs change? And we're going to talk about that, even though we're not going to estimate that. So we're going to estimate this, and talk about this. Okay. I'm not going to go into size-dependent enforcement in detail, and I'm going to pause now for some questions before I get into the empirical results.
All right, great. Thanks, Ben. That's a very good time just to stop and so collate questions. So if anybody has a question, they can raise their hand, and I guess the panelists can just go ahead and ask their question.
Ben, can I just clarify? It sounded in the beginning like you were talking about reporting profits, reported revenues that weren't real, and then in the model it became kind of real. And I guess which of these maybe you're going to get to this when you get to the data, but which of these are you?
Yeah. This is okay. No, that's a great question. This is taxable income. This is tax. So in the model, that's kind of, I skipped through this a little quickly, but in the model we have, so everything I'm going to look at in the data is going to be reported, just to be clear. Okay. In the model, that's okay. Kind of the key point of a lot of this kind of Feldstein and the following related papers is that for welfare, the thing you actually care about is the reported income to the government. And that's kind of what this envelope theorem argument is saying is you can see all the revenue is here. Like the post-tax profits and evaded lines, they're all here. But when I take kind of the derivative of this thing with respect to the tax rate, I get, the only terms that matter are the direct effect here on taxable income and the government budget constraint. So this is this sort of standard kind of argument that for all of these tax changes, what I care about is the total effect on kind of through the government budget constraint.
Okay, so Francesco,
it's a quite convenient result. It basically says that the thing for welfare, this is why this result has been so powerful in PF, is it basically says for welfare, the thing you want to estimate for social welfare turns out to be the thing you can estimate in the data. You can observe in the data.
So Francesco Modio had a question as well. Francesco, why don't you just, or do I need to unmute you too?
Yes, can you hear me?
Yep, go ahead, Francesco.
Yeah. Hi, this is super interesting, thanks. I was just wondering, so am I right in understanding that the price component of firm revenues is held fixed in the model? Like, couldn't we think that firms are able to, at least to some extent, pass through some of the cost of taxes or non-compliance to consumers at least to some extent, and
Yeah, that's a great question, and I will be honest, that is not something I've thought through carefully about how the effects and the change in how that would affect things. I haven't actually gotten that comment before. I haven't thought through what happens in a world where you embed this with kind of imperfect pass-through.
Also for welfare considerations, I think that would be interesting to understand how.
Yeah. I think it's going to depend on whether that changes consumption decisions. I don't know the answer off the top of my head.
Thanks.
Okay, Ben, oh, sorry, Dave.
Oh, I just wanted to follow up on that. Just to understand the consumer surplus, you're saying in a competitive setting with, like, say, perfect pass-through, then that the effect on consumer surplus is irrelevant.
Yeah, it's going to go. So I think that my intuition is exactly that, because it just cancels in the welfare. Like if we put consumers in and we put the welfare function in, I think it's going to cancel. Like it's going to go, like if it's just a transfer from consumers to firms, that doesn't matter for social welfare. So my intuition was it's going to matter only if it kind of affects decisions. And then I think there may even be an envelope theorem argument that none of that actually matters. That's my gut sense, but I haven't thought it through carefully enough.
Okay. Constant
What, sorry?
It seems like normally you need constant, not just perfect competition, but constant returns, right? The firm.
So the short answer is, Dave, I haven't thought this through. So that was my first answer is I'm not 100% sure. But my sense is whether it would affect real distortions, and the second is whether those real distortions would somehow like be large enough to escape an envelope theorem argument, but I'm not sure. Because everyone's optimizing like at the P-period, right? So like the consumers are optimizing and the firms are optimizing. And so if you do the whole social welfare with respect to the envelope theorem, I think that's why in general the envelope theorem argument is still going to go through, I think, but I'm not sure.
Thanks.
Okay, that's great. Then why don't you crack on then?
Great. So let me talk about the empirics now. So the empirical design is that basically the empirical challenge, of course, is that these MTO firms are large. They're larger than everybody else by construction. So we're going to do a match differences and differences. Okay, so we're going to and we'll compute event study versions of this, etc. One thing to note is that some additional firms were moved into the MTO starting a few years later, 2009. We're just going to use the initial assignment. We're going to match on pre-period, which is 2005. The thing starts in 2007, but 2006 was a partially affected year, so we're going to call 2005 as our last kind of pre-period year. We'll match in 2005, and we're going to instrument for subsequent assignment using your 2005 assignment. Okay, and that works really well. And for matching, we need to sort of restrict. We're going to restrict to a common support. So this is actually important. So, in general, the firms that get assigned are really big, and the firms that don't get assigned are small. So we're going to sort of restrict to sort of we're going to take a standard assumption of like we'll pick the 97%. We'll exclude 5% on either side, or 5% total, so 2.5% on either side. So we're going to exclude firms for which we have very few possible controls or very few possible treatments. So you should think of the relevant analysis set as kind of a smallest half of the MTO firms, and those are the ones that we can do a reasonable job matching on. And we do that for both on both of the two things we're matching on, which is gross income and taxes paid. Oops. Okay. We're going to use this Heinmüller et al. Entropy balancing matching. So if you haven't used this, I highly recommend checking it out. It basically, there's been a bunch of sort of advances in propensity score matching over the last few years, which basically argue that if you don't know the exact functional form of the propensity score, there are sort of non-parametric matching methods where you basically say, here are the moments I want to hit. What is the set of weights that is the least deviation from the uniform weights that allows me to sort of match on these moments? Okay, and that's what this Heinmüller et al. Or Heinmüller method does. And there's been some, Atkin and Imran have a nice paper showing that this kind of works better when propensity score isn't exact, but we actually can do robustness to propensity score matching using kind of more parametric approaches, and it gets you pretty similar results. The other thing I'll just note is we match on the level in 2005. So we're not matching on the trend. So that is helpful because it can allow us to assess whether these firms were on different trends to begin with, because we're not explicitly matching on the trend. If in fact we do match on the trends as well as the levels, we get pretty similar answers. Doesn't really matter. Okay, so this just shows you the matched, this is revenue on the left-hand side, government tax revenue, sorry, government tax revenue on the left-hand side. And this is showing you just the raw data after applying the weights, okay? This is the non-MTO group. This is the MTO group. 2006 was kind of the partially affected year. 2007 is the first fully affected year. So you can see these groups look like they're on a very similar pre-trend, and then something pretty substantial happens when they get moved to the MTO, and this gap widens over time. So this is the sort of regression version of this graph. So you can see a pretty big on-impact effect that, if anything, sort of increases over time. So how big is this? Well, we run the specification. As I mentioned, we run an IV to take into account the fact that some of the control groups get merged into the treatment group over time, and we compare the effects that we're estimating as a function of kind of like the control complier means, and we get really big effects. So the magnitude is, VAT revenues go up by 137%, corporate income tax go up by 111%. Other remitted income taxes go up by 113%. In total, the total taxes paid by the firms over the subsequent 6 years go up by 128%. So these are really big. This is not driven by changes in what's happening in the control group. You can kind of see that already, that this control group was kind of pretty flat over here. One thing that we can do here is we can actually subdivide the control group into the ones that were kind of close and the ones that were further apart, and they both look like they're on similar trends. It's not like the firms that just missed, kind of like their revenue fell because they were avoiding going to the MTO. This is all happening through what's happening in the treatment group. Now, as I mentioned, this is the effect on net revenue, gross revenue to the government. You actually have to subtract off the second thing we needed to do is subtract off the cost to the government of collecting this. And now we can actually estimate through administrative data. We just get the budgets of what does it cost to run a medium tax office and what does it cost to run a small tax office, and divide by the number of corporate taxpayers. We have to make some assumptions for the individual income taxpayers. And roughly speaking, we get an estimate that's about 2 orders of magnitude smaller. So it costs a difference of about 300. This is in rupiah, but it's about $300 a year per corporate taxpayer. Is the difference of running these more intensive offices. So it's 2 orders of magnitude smaller. So the gross and the net gains are basically the same to the government. Okay, so that's kind of the second key point. The other thing which is kind of interesting, as I mentioned, is we get results on top line revenues, not just on bottom line revenues. So there's a lot of discussion in kind of the literature on corporate taxation of like, oh, it's about kind of making it harder for you to deduct your costs. And I think it's important to just recognize that's not what we're seeing in the data. What we're seeing in the data is top line revenues are going up by a lot, by sort of similar percentages. And in fact, costs are also going up, okay? And the reported profit margin of the firm is kind of unchanged. So it really is about getting more revenue kind of onto the books that the government sort of is observing, but revenue with its associated costs, like these whole new businesses getting, or business lines or relationships or whatever being reported, not just sort of making it more difficult for you to sort of scrutinize your deductions. It's also not about collections, by the way. The percentage due paid as a function of the percentage due is unchanged. This is not about collections. It's not about scrutiny of your costs. It's really about sort of discovering kind of more revenue. And sometimes the motivation for writing the model was we think that's a little bit different than how people tend to think about corporate tax evasion in a lot of other papers, and we just sort of wanted to sort of make that point because that's very they also sort of report more workers. Now, this is all reported, so we don't know if this is real firm growth or workers being brought onto the books, but it's going up. And so in particular, the report, this is like, they have to report this because they're paying employment taxes or whatever. These firms have a lot more temporary workers than permanent workers. Our estimates for temporary workers are total kind of noise, nothing significant. A big standard error, so, because those bounce around a lot, but permanent workers go up by about 20%. Okay, so again, this could be increased, it could be sort of we're discovering more stuff. It could be increased scrutiny and sort of saying, look, no, like, Dave's been at MIT for many years, he should really be a permanent worker at this point. But this is also kind of going up, and it's consistent with kind of increased, formalization or something for these workers. So why might this be working so well? Well, what do we see? So we see that, it's substantially higher tax payments, even net of administration costs, higher top line revenue, not just bottom line profits, increased formal permanent employees and payroll. And as I mentioned, these effects are bigger afterwards. So if you compare them 2 years post to 6 years post on both tax revenue and gross income, there's a substantial difference. The amount of tax revenue, the increase compared to the baseline, these are both compared to baseline, is a lot bigger 6 years later than 2 years later. Okay. It's not that the MTO is increasing its enforcement activities over time, like staff ratios are kind of the same. So something's going on. Now, it could just be it takes some time to learn some stuff, could be. But we think it's kind of interesting that, you might have predicted that these effects would would get smaller over time as firms learn how to evade or whatever, but or if there are real distortionary costs, but that's just not what we're seeing. So one thing we want to explore is this idea that maybe actually, despite the higher kind of effective tax rate, something else was changing. And so we want to look at this one idea that we mentioned about size-dependent enforcement. Okay. And so this is just the notation of size-dependent enforcement and the model that I didn't go through. We have in our data 3 different types of enforcement measures. Now, it's important to be clear that the government does many, many things to enforce, many of which are not measured in our data. So for example, the key contact person is called an account representative. The account representatives can pick up the phone and call REMA and say, hey, I want you to come in and report your taxes or whatever. That's not in our data. Okay, we only have data on a few specific activities, which are formally recorded in their information systems. So this is a subset of everything going on, but nevertheless, we can measure it, and we can measure it identically in both the the large tax offices and the small tax offices. And so and those 3 are formal audits, VAT underpayment letters and VAT collection letters, whatever those are. And we can look at them as a function, both of level and as a function of firm size. Okay, and we're going to use the same balancing weights, so you can think of this as the same identification we had before. So we can plot these as a function of the firm's total taxes paid, or as a function of the total kind of size of the firm as measured by workers. And what you can see, this one on the left is probably the least clear of all of them. So the blue line is the MTOs, and the red line is the non-MTOs. So everywhere they're doing more of this stuff. Okay. But the other thing that's interesting is in the non-MTOs, they tend to be focused on the really big firms, whereas they tend to be much more uniform in their enforcement in the MTOs. And that's true on all 3 measures we have: these formal audits, these VAT underpayment letters, and these VAT tax collection letters. They all show this same pattern where the blue line is higher, but also flatter than the red line. And what we think is that suggests that at least one thing that's going on is that while they're increasing the level of enforcement activity, they're making it less size dependent, and therefore potentially reducing a disincentive to grow. And we think that could be offsetting potentially the higher marginal tax rates. Okay, so summing up so far, I've only got about 6 minutes left, but that should be okay. So, improved tax administration led to higher revenues of all types, driven by more top-line revenues being recorded, not decreased deductions or improved collections, didn't slow the rate of firm growth, I think we can certainly say that, and has reduced size-dependent enforcement. So now we want to say, well, how did this compare to changing marginal rates? Okay, so as I mentioned, we're going to use this change in the rate schedule from a rate that was a function of gross income to one that was a function of net income to one that was a function of gross income. And we're going to use that to estimate the legislative taxable income. Okay, so this shows you the 2008-2009 schedule change as a function of your gross income. Your gross income. I'll make that go away. There we go. Your gross income on the x-axis and your taxable income on the y-axis in the pre-period, in the previous year. And so you can see that firms that had low taxable income but high gross income, those people get a tax increase. Firms that had high taxable income but low gross income get a big tax cut. and so on. And there are firms spread throughout this space. Okay, so we have this tax change, and then we have a second tax change. In the second year, everybody gets a tax cut, but it's differential, depending mostly on your pre-period gross income, depending only on your pre-period gross income. Okay, so we have these two different tax changes, this big one and then this other one that happens after that. So what we do is we estimate sort of the standard kind of IV ETI regression, where you look at the change in your taxable income as a function of the change in your tax rate, or 1 minus your tax rate, controlling for the sort of the key inputs in that, which are your taxable income and your gross income. We instrument for the change in the tax rate by taking your pre-period gross and taxable income and feeding it through the two schedule changes. Okay, so it's instrumented, not allowing for sort of endogenous reactions. And because we have two changes, we can actually do this whole thing with firm fixed FX. Okay, so the instrumented first stage works great. We have an F-stat of like 3,000. So even with the new results say you have to have a higher F-stat for your first stage for IV to work, we're still well clear of that bar. And more importantly, we get an ETI of about 0.6. Okay, and one question that often comes up is, does the MTO, the Better Tax Administration, change the elasticity of taxable income? And here, this is something I wish we had stronger results to say here. Unfortunately, the point estimates suggest that the ETI is lower with the MTO than in the non-MTO. This is not something we can really statistically distinguish in this context. Like, it's 0.32, and honestly, when we run different specifications, this number is pretty robust, but sort of this difference kind of bounces around a bit. So I don't think we have, unfortunately, much to say on that, even though it's an interesting question. So finally, well, what do we? So with an ETI of 0.59. What does that mean? It means a bunch of things. For example, it means that the LAFR rate in Indonesia is 56%. So the top rate in this context was 30%, then they cut it to 28 and 25. They recently I think, just cut it again to 20. But it's worth noting that the LAFR rate here is 56. Okay, so this is not a context where they couldn't raise more revenue through tax rates if they wanted to, right? And if you think that sort of how much they should depends on the social value of public funds. If you think that V is 2, for example, so that government funds are worth twice as much as private funds, that would give you an optimal rate of 39%, for example, substantially higher than their current rate. Okay, so they're definitely below the LAFR rate here. So that's all true. We can also then use it to do some of the counterfactuals that I was talking about before. Okay, and so the final kind of exercise we do in the paper is we'll say, well, let's compare these two different things. And let's say, well, how big of a tax increase would you need to do to get the same amount of tax revenue you got from the corporate tax, from the tax administration increase, taking into account kind of this ETI, right? So the calculation we do is, let's say we're in the pre-period schedule, the one with the sort of highest marginal rate. So we'll have to take into account the fact that we're only going to raise the top rate. And we can actually, then we can sort of run this calculation. And the answer is that to get just for corporate income tax, okay, we would have to raise you have to raise the rate on all taxpayers by 8 percentage points. If you were to think about all of the income taxes, including withholding taxes, you'd have to be 17 percentage points. You couldn't get all of the money you got from everything just by corporate income tax. You'd be above the LAFR rate. Like if you added in all the money you got from VAT and all that stuff, just by trying to get it through the corporate income tax, you couldn't do it. Okay, and so we think this 8 percentage point number is pretty big. In terms of welfare analysis, the key thing to think about is you have to take into account the change in private compliance costs. So you have to say, well, is this change in welfare greater than the change in compliance costs? I'm running out of time, but basically the key sort of thing that these formulas give you is the following, which is to say, what the formulas basically say is, if the change for this thing, for doing a marginal increase through administration to have been a worse idea than doing it by raising rates, you would need that the change in private compliance costs would have to be bigger than this change you got from this welfare neutral tax change by 1.51. Okay, so it would be true if the revenue gains for, so it's basically the administration gains would be the administration approach would be better if the private compliance, even if the private compliance costs were 1/66, 1.51 times as big as the change in government revenue, and the change in government revenue was really enormous. Okay, so the change in private compliance costs would have had to be even more enormous than that for this not to be a good idea. And what do we know about private compliance costs? Well, they actually did a survey from AC Nielsen. We don't have the microdata, but we have the summary results where they asked firms in the PTO and the MTO, how easy is it for you to deal with the tax office? What is your satisfaction with dealing with the tax office? And if anything, they say the MTO ones give higher ratings for the tax office. And that's in part because they improve they're there not just to enforce on you, but to actually make it easier for you to pay taxes, because there's taxes are really complicated. They're complicated for firms everywhere. They're particularly complicated for a firm in a place like Indonesia. And one thing firms really value is being able to have someone who actually answers the phone when you call and sort of explains how you sort of pay your taxes. So at least there's an argument that private compliance costs actually went down, not up, in the MTO. Okay, so I'm a bit over time, but just to take stock, what have we found in this paper? So we examined whether there were changes in tax administration and tax rates, whether those could raise large amounts of revenue in an emerging country economy, and the trade-offs between these two approaches. We found that the tax administration reform had really large effects on government revenue. And we think that potentially the sort of lack of size, making it less size dependent, was one reason why it may have been able to do that without leading to major firm distortions. And our results suggest that tax administration reforms can be as important, if not even more important, than reforms to tax rate structures in this context. Okay, thank you.
Thanks, Ben. That was fantastic. So we can open things up for the Q&A. So I have a question from, I think Michael Gechter has a question. So, and then Gabrielle has a question as well. So Michael, do you want to just unmute yourself and ask your question?
Size dependency off of the common support. So if you compared enforcement probabilities in the pre-splitting into MTO and non-MTO versus this post to get a sense of what's going on in the.
I'm sorry, Michael. Sorry, the first half of your comment was cut off. Sorry. So what were you? Oh,
okay. Yeah. So I'm wondering what enforcement probabilities look like pre-MTO, and then make a comparison with the right tail of the distribution.
Yeah, so I don't think I have the graphs of this, but we did include we do have for two of the three measures, we have it afterwards. So we do estimate this is a diff and diff as well.
Okay.
And so this is the triple diff, right? So it's a triple diff, right? So it's as a function of assignment times how big you are times post, basically. And so we find that this is sort of how does the slope change in the post period, and it gets more negative. So that's that we do for two of our three measures have a diff and diff version of that thing as well. For the audits, the audit data starts in 2008, so we can't do it in the pre-period. I don't think we have I don't have graphs of this.
And so that's saying, just so I get it right, so that's saying that the flattening carries over off of the common support. Is that right?
No, I wasn't answering your common support question. I was saying, I thought you were asking about an additional question, which is how does it change over time? So I was just saying that wasn't the common support question. I don't remember I don't think we've run that regression, but I was saying that at least it does go through in kind of the diff and diff, like as a change as well as a level.
Got it.
Yeah.
So I think we had a question from Gabriel Ulysses, but I'm not sure if I see Gabriel there.
I'm here.
Yeah, Gabriel's here. I see Gabriel.
Okay, great. Go ahead, Gabriel.
Hi, Ben. Hi, everyone. This is great.
Hi,
very interesting. I was just wondering if you can or had a chance to look at potential reallocation effects from these policies across firms, like gaining or losing market share. I was thinking about that because that could be one potential big difference between the increasing tax rates versus changing the enforcement technology, because that becomes less size dependent. For example, like the M2, I think it's like the graphs you should suggest that. So like you could see more resources flowing or market share flowing from less productive, more likely to avoid taxes firms to more productive firms. And I was wondering if you can do something with your data on that, perhaps even looking at potential spillovers to larger firms that were not so affected by the reform, maybe, but like, you know, but even then got positively affected or something like that.
Yeah, so I'm not sure. First of all, we can't really measure productivity in the tax data, at least as far as we can tell.
Right, yeah.
We thought about that, and I don't think we have the variables you need to really sort of measure that. And second of all, of course,
I don't know. Yeah.
No, you can't. Unfortunately, because of the anonymized data, we can't look at this stuff in any other context, and because there's no, like, it's all at the firm level, not kind of we can't really look at this in other data sets. And we spent a lot of time trying to see if we could do something like that, and I don't think we can do sort of effective matching to other data sets where we can really look at those productivity type effects. Like, what we thought about something of like what share of firms in this industry in this region were treated or something, and we couldn't really make that work in a convincing way.
Thanks.
We tried, though.
So Ben, I had a question just with regards to the MTO, a point that you made earlier about sort of the new individuals working in the offices were of very similar human capital to the ones who were already in those offices. And so normally we think of one constraint on the administrative capacity of the state, that on the margin we'd hire worse quality individuals to be part of the state. So is that constraint not binding here, or are these individuals being reassigned from somewhere else in the system, or what's going on there? That
Yeah. So just to be clear, what's happening is they are splitting the system, right? So they are well, first of all, there's a couple of things. The first is this is a pretty small. At least this level of reform is pretty small relative to the total number of people in the system. So there are 19 MTOs, and there are 300 and something primary offices. So even with that's probably the first order point, which is even if with 3 times as many staff per taxpayer as in the primary offices, this is pretty small relative to the overall ratio of people in the primary offices. So you're not diluting it that much. The second is the government is recruiting large numbers of these people and sort of working them up and promoting them through their systems every year. Indonesia actually has a whole sort of separate college that trains people just for the finance ministry. And I think that they can sort of, by adjusting that sort of input margin, sort of they can, bring more people into the system. All that to say, if you thought about substantial enlarging this kind of way down, it would have kind of bigger general equilibrium effects on kind of the overall composition of the tax force. I think it's small relative to Indonesia, and they could certainly over time just increase the admissions at STAN, their sort of Ministry of Tax College, or transfer more people from other parts of the ministry to tax. So I think they have it's relatively small relative to the total size of their system. So I guess I have 2 points. Number one is I don't think it affects our estimation here. And I think for scale up, I actually think that although it would take, these people have about 7 years of experience on average. So it would take them a little bit of time to bring in new people, but not forever.
Okay, that's great. So are there any other questions?
Is there time? I had a quick question. Ben, which is basically about the political economy of all this. So it does seem like a no-brainer. It often seems like a no-brainer, like increasing enforcement would raise tax revenue. No, and then you ask, like, why aren't countries doing this? And in part, it's the political economy. It's that there's a huge amount of resistance that comes out from these firms that are now, having increased enforcement. And so I guess but it makes me think that maybe we should think about that in our models about like what's the political cost somehow to the government.
Totally. One thing that I think helps here is. I think 2 things help. Number one is, the main thing I was thinking that probably helps a little bit is that it's not clear firms are so unhappy about this, because as measured by at least this kind of satisfaction kind of measure,
which is weird. Yeah.
Well, it isn't weird. Like on the one hand, like it's not. You could imagine that firms, remember in the model, the firms are paying all those evasion costs on the marginal evaded line, and that's kind of not that pleasant for them either. So on the margin, you have these second order differences for the firm, but first order gains for kind of the government, for the marginal firms. Obviously, for the inframarginal firms, which have first order kind of costs as well. But I think that so I think that's kind of relevant. And also, I think that the fact that just sort of thinking in the real world, I think firms find dealing with the tax administration difficult and confusing. And if you can make it there's a potential, part of this is antagonistic, which is like I'm transferring resources from A to B, right? That's just antagonistic. But there's an additional part of it, which is just I can just make everyone better. I can make the firms better off by sort of explaining how I'm supposed to do this kind of properly. And I think that could be at least one thing that partially helps offset part of the political economy costs. I'm not saying like this is a panacea and everyone's like, oh, yay, like I want more tax enforcement. But I do think that, you know, having dealt with the Indonesian tax authority or having seen some of their stuff on the other side, it is confusing and opaque and difficult. And, you know, being able to have someone who can call up and get a straight answer on something could actually be worth a lot to some of these firms.
We should probably bring the session to a close. We've had two great papers, and now we have a half-hour break before we have the panel session starting at 10:30. So thanks to our speakers, and see everyone in about half an hour.